Real estate or stocks? It's like the biggest debate in investing, right? Everybody seems to have a super strong opinion. But what if I told you that most of the math people use is, well, it's missing some pretty huge pieces of the puzzle? Today, we're going to settle it. We're going to follow a 20-year experiment to see which path really builds more wealth when you count everything.
And this quote, this is basically the key to the whole thing. It hints that both sides of this argument are missing something absolutely critical. And by the end of this, you are going to know exactly what that means.
All right, let's meet our two investors, Jake and Marcus. Now, financially, they are basically clones. Same savings, same income. But they make one single different choice that changes everything. Jake buys a house, something real he can touch, and instantly, he feels like a genius. Marcus, on the other hand, buys a boring old index fund and crickets. Nobody cares. His choice feels totally invisible. And that feeling right there is where this whole story kicks off.
So, let's officially set the stage for their 20-year financial showdown. We're going to follow them step by step and see how these two very different paths play out, not in theory, but in the real world. Okay, check this out. They both start with the exact same $50,000. Jake uses his as a 20% down payment to control a $250,000 house. Marcus just puts his 50 grand into an S&P 500 fund and sets up a simple automatic $300 a month contribution. And you can see the difference immediately. On day one, Jake feels like a real estate mogul. Marcus feels like he just filed some paperwork.
Now, for the first few years, this thing looks like a total blowout. I mean, Jake seems to be absolutely crushing it, living the landlord dream. But as we're about to see, the numbers you see on paper can create a really powerful illusion.
So let's just look at the simple math that everyone talks about. Over 3 years, Jake collects rent, he pays his mortgage, and the difference? A very nice $16,920. He's probably bragging about it at parties. I mean, looks like a massive win, doesn't it?
But hold on a second. Let's start peeling back the layers of reality. First, property taxes come and take a huge bite out of that. Then comes insurance. Oh, and of course the water heater broke and the roof had a small leak, that's maintenance. And yeah, the property sat empty for a month between tenants. All of a sudden, that nice pile of cash starts to just evaporate.
And here it is. Here's the gut punch. After you account for all the real-world costs, the stuff nobody ever puts in the headlines, Jake's impressive 16 grand in profit is actually closer to just 2,000 bucks. That's a brutal reality check. And that's before we've even counted a single hour of his time. Based on cash flow alone, this looks like a terrible investment. But, and this is so key to understanding real estate, cash flow is only half the story. So how is Jake even still in the game? Well, the answer is one single powerful word: leverage. He put down $50,000 to control a $250,000 asset. This 5-to-1 power is real estate's greatest advantage. It lets him benefit from the appreciation of the entire house, not just his little slice.
Okay, time for our first check-in. At the 3-year mark, Jake's equity in his house is around $60,000. Not bad at all. That's leverage doing its thing. But look at Marcus. His portfolio, quietly growing from his contributions and market returns, is already at $76,000. So here's the big insight. In the early years, effortless consistency can actually beat high-effort leverage. Marcus is ahead.
And that brings us to the 10-year mark. All that early noise has started to settle down. And now, the real fundamental engines of each investment are about to show their true power. This is where the race gets really interesting.
See, while Jake was busy dealing with tenants and toilets, this quiet, invisible force was working for Marcus. It's called compounding. It's that magical process where your money starts making its own money. It's kind of boring for the first few years, not gonna lie, but then it becomes this incredible, accelerating force. It's the engine of all passive investing. And boom, here it is. This is the turning point. By year 10, Jake's equity has soared to about $177,000. A fantastic result, right? But look at Marcus. His totally hands-off portfolio, fueled by that quiet power of compounding, is sitting at $172,000. They are neck and neck. This is the exact moment where the slow, quiet power of compounding officially catches up to the loud, high-effort power of leverage.
And this brings us right back to that quote from the beginning of our story. To get to basically the same financial destination, Jake had to spend hundreds of hours working a part-time job that he wasn't really getting paid for. He was counting the zeros in his bank account, but he completely forgot to count the hours. Marcus, he spent 0 time, 0 stress.
Okay, it's time for the grand finale. 2 whole decades have gone by. The mortgage is almost gone, the stock market has gone through booms and busts. What is the final result of this long, long bet?
And the results are in. After 20 years, Jake's equity in his property is worth about $450,000. I mean, an absolutely incredible outcome. And Marcus's stock portfolio, it's sitting at about $440,000. Get this, they've landed in almost the exact same place financially.
So here's the real punchline. The final number is nearly identical, but their experience, their journey, could not have been more different. Jake had to actively work for his wealth, dealing with stress, risk, and having all his money tied up in one asset. Marcus's wealth, it just grew while he was sleeping. One worked, the other waited.
So let's take a step back from the story for a second and just lay out the core trade-offs nice and clear. What are the fundamental strengths and weaknesses of each path that this 20-year journey showed us?
This breaks it down perfectly. Real estate gives you that incredible leverage, that 5-to-1 power, but it demands your time and it locks up your money. It's hard to sell. Stocks, on the other hand, give you amazing simplicity, and you can sell them anytime, but you have to deal with market swings and the very real risk of panic selling when things get scary. It's a clear trade-off, power versus simplicity.
And just to be clear, real estate has some serious, almost unfair advantages that stocks just can't touch. You've got leverage, of course, but you also get amazing tax breaks like deducting interest and even depreciation. It's a physical thing you can see and improve. And there are advanced strategies like 1031 exchanges that let you defer taxes in a way stock investors can only dream about.
But don't count the stock market out. It has its own set of superpowers. You get instant diversification across thousands of companies. You can turn your investment into cash in just a few days. And of course the big one, truly passive growth. No tenants, no toilets, no turnover. Just compounding doing all the heavy lifting for you.
So, after all that, what's the right answer? Which one is actually better? Well, that brings us to the single most important takeaway from this whole thing.
The truth is, there is no single right answer. The real trap isn't the asset you choose. The trap is making that decision based on some YouTube headline or what your uncle told you at Thanksgiving without actually running the full numbers, counting all the costs, both in dollars and in hours, for your own specific life.
So from now on, the next time you hear someone declare with absolute certainty that real estate always wins, or that stocks are obviously the superior choice, you now have the single most powerful question you can ask them. Did you include everything? Because as we saw with Jake and Marcus, the only answer that truly matters is the one that does.